10 voting members on the U.S. Federal Reserve Board have the power to influence the global economy. The question dominating the financial world: will they raise interest rates? Why is that so significant? We'll explore the topic on today's Inside Story. Hello and welcome to the program. I'm Mike Hanna. Two of the globe's most powerful economies have the world virtually on edge. Last week, China's market plunge sent international markets into a slide. Now all eyes are on the US as the Federal Reserve prepares to decide whether or not to raise interest rates. Let's begin by explaining what the Federal Reserve is and what it does. The Fed is America's central bank, charged with controlling monetary policy to keep the economy in good shape, keep employment high, and stabilize prices. To do that, it sets the rate of interest at which member banks can loan money, and the rates at which banks borrow from each other. That's used to determine interest rates on things like credit cards, car loans, or small business loans. The Fed raises the rate when the economy is growing too fast, which encourages people to spend less and save more. When the economy is in a slowdown, it reduces the rate, which lowers borrowing rates and helps stimulate the economy. The last time it raised the rate was in 2006 to around 5.25%. Then the crash happened in 2008, and the rate was ratcheted down to close to 0%. Well, let's now introduce our guests. In New York, Mike Norman, a foreign exchange trader and economist. In Beijing, Einar Tangen, economic affairs commentator at China Radio International. And in London, Jan Randolph, the Director of Sovereign Risk Analysis at IHS Global Insight. Welcome to you all. Let's begin in New York with Mike Norman. Certainly there are strong opinions for and against raising interest rates, and reports too that even members of the Federal Open Market Committee are divided on the issue. Your view?
Well, they are divided. They've been divided for a while, but there is this sense emanating from the Fed for a long time now that they want to normalize rates in their opinion. They see the zero interest rate policy as an artificially low rate. However, what is keeping, and by the way, I should mention that this is probably one of the most telegraphed rate increases in history. I mean, people have been anticipating this for a long time. The Fed has been, suggesting that this will happen. The problem is now we have some external factors that have come into the equation, that being China, of course, recent market volatility, and even some of the economic data in the United States, which still suggests some softness or vulnerability. So probably right now where the market for investors, they were looking at the possibility of a September rate increase, probably pushes that back now to more like sometime in the fall or December.
Well, Einar Tangen, we had heard mention there that this has been a wildly signaled rates increase, almost one by stealth, it would appear. What's the view from Beijing? Is the rates increase expected, and when?
From Beijing's point of view, it's been expected for a long time. As it was pointed out, this has been long telegraphed. This has given people a lot of opportunity to adjust their positions, and it's a reason why $1 trillion has drained out, particularly out of Southeast Asia, over the last year. So everyone's expecting it. I think because of that, Yellen has been and the Fed has been very, very cautious. This is the right way to do it. You're easing back into the situation. The last thing they want to do it. But I'm going to disagree. I think September is the date. I think they want to show a little tough love and resolve. I think the latest numbers, the revised commerce numbers, coming in better than expected. Employment still good. I think that this is the time to begin. As I said, very small steps to begin with, and then see what happens as it goes forward.
Well, Janet Yellen, that you mentioned, the head of that federal committee. But Jan Randolph, what are your expectations? Are you expecting to see this rates rise sooner rather than later?
The day is definitely coming closer. The timing is very important for any central bank after so many years of monetary accommodation, super accommodation with quantitative easing. So it's an important decision to stop monetary accommodation. I think the interesting question is to what extent the US will take into account external or rest of the world factors. And we've mentioned slowdown in China, the turmoil in commodity markets, recessions in Russia and Brazil. In the past, all central banks are quite selfish. They look at their own economies. They take a diagnostic of their own economies. Is it strong enough to withstand the switchover to an increase in rates, no matter how small or gentle? It is psychologically important. It is a bit like passing the baton in a relay race. You have to make sure the person behind you can pick it up. The question is private sector, the labor market, strong enough in the US to carry the baton of global growth off the shoulders of the central bank? I mean, that's how important it is. And I think the Fed is quite cautious and will take into account global factors more so than in any previous rate decision, because it realizes that the rest of the world matters for growth and can impact back on the US through lower inflation, through weaker external demand. And I think it will err on the side of caution. And I think what's happening globally in China, commodity markets, slower growth in emerging markets, deflationary impact from the yuan exchange rate change, I think that will wash out, but it'll also give time, more waiting room time for the Fed. So it may leave it until November, December.
Right, just to mention that the phrase you used there, quantitative easing, was the experiment in money printing that did keep interest rates low, but also threatened at stages to create a stock market bubble. But Mike Norman, what are the criteria on which the Federal Committee decides? Now, Janet Yellen speaks about data dependence in her approach to interest rates, as though it's a objective decision rather than a subjective one. What actually persuades the Federal Committee to take action?
Well, you know, the Fed has a dual mandate, and that is low inflation and employment. So it is definitely looking at the job situation. It has referenced that. It has mentioned that many times, even going back to when Bernanke was in his term. But they're looking at the broad scope of economic data. And clearly, I mean, we saw a very strong second quarter GDP in the United States. I would say that were it not for the China situation, your other guest mentioned weak commodity prices. I agree with that. Were it not for those developments, I think that second quarter GDP print of 3.7%, that would have been the deciding factor, and they would have gone ahead. I think for the Fed, as much as they do want to raise rates, in their mind, viewing that as normalizing rates, I think they are willing to give it a few more months, perhaps until the end of the year, as I mentioned. The other factor I should point out was the dollar, which had been very, very strong, has been very, very strong. We've seen some correction in the dollar recently, not a lot, but they also have mentioned the dollar as a point of focus, something they have been paying attention to, in that it could impede some of the stimulus or some of the work that the Fed itself is trying to do. So I think the dollar pullback here probably in their eyes is more of a positive in terms of moving forward on that rate hike sometime later this year.
Well, Aina Tangen, there is a vast amount of dollars sitting in China and propping up the Chinese economy. Is there a threat that the dollar could be strengthened even further, creating, as you mentioned, that flight of capital or removal of capital from the Chinese system and pushed back into the United States with the rates increase? Is there a threat of that?
As I said before, it's been anticipated for quite some time. This is not something that's going to affect China tremendously directly. It'll be mostly indirect. What's going to happen is already the liquidity crisis, which is swinging into effect especially through Southeast Asia and the area where they want to put in this one belt, one road. it'll actually be an opportunity because China has been setting up the BRICS Bank, the AIIB, both for investment, but also for just this kind of liquidity crisis. This will give them an opportunity to show some leadership as these countries become desperate for Forex to pay off loans and as money starts to dry up and as additional funds are taken out. So from the Chinese perspective, this is something that they don't mind seeing happen, especially from a geopolitical perspective. Economically, because of China's vast reserves, I think there's very little doubt that will go higher. There is some anticipation and some concern about money outflows that have been happening. They're expecting to reach $100 billion in this last quarter. If that continues, you can see some efforts by the central bank to continue curtailing that beyond what they're doing now.
Well, let's just take a look at the wider global implications. The effects of an interest rate hike will be felt all around the world. A higher rate will strengthen the dollar, which could have an impact on emerging markets. Many of them have borrowed huge sums in US dollars, and a stronger dollar will make it harder for them to pay off their debts. A stronger dollar could also lead to investors pulling their money out of emerging markets and back into the US, as we heard. China's central bank and the International Monetary Fund have both urged the Fed to hold off until the world economy is more stable. But some central bankers say a hike in interest rates has long been expected and that they're prepared to pay for it. Well, Jan Randolph, the decision being made by the Federal Committee could impact on more than 9 trillion borrowed dollars, which is being held outside the US. So obviously it does have massive global ramifications. What kind of impact do you think a rates increase, no matter how small, could have on the economies, particularly of emerging countries?
Well, we've already seen a rehearsal of this with the taper tantrum. This is when the US Federal Reserve started shortening or lowering the amount of injection of money through quantitative easing. Now it's stopped that, and now it's going to start a rate rise. So we're going to see continued outflows from emerging markets to the funding currencies of rock bottom interest rates. That's not just the dollar zone, US dollar zone, but also the eurozone and Japanese yen. And when we see that, we see a gentle strengthening of the currencies, the euro, yen, and the US dollar. What that means for emerging markets, it basically reveals those that have been dependent or perhaps overly dependent on this overspill of money, cheap credit coming from the US mainly, but now also from Europe and Japan, where they find it more difficult to finance either their deficits, their external or their fiscal, or it means that those that have borrowed in hard currencies, corporates, banks, sovereigns, may find it more difficult. Though typically it's those countries with large external deficits that are more exposed, like Turkey, many in Latin America, South Africa. India's got a small current account deficit. Some of these may not be as well covered by foreign direct investment, and if they'd been reliant on global financial flows, complements of quantitative easing and rock bottom interest rates in the West, that means the era of cheap credit is over. And a premium on emerging markets that will be able to navigate these much more difficult external waters, not just weaker demand from China, lower commodity prices, but also now more expensive credit from overseas. It means that they have to rely more on internal growth, structural reforms, supply-side measures, privatization, building their own financial systems, making more efficient use of domestic savings, and making use of local currency debt. These are the countries that will navigate better than others. And we're seeing throughout the emerging market world huge adjustments, depegging from exchange rates from the dollar, weakening of currencies. Even the Chinese yuan now is weakening on a new crawling peg rate. And that has ramifications. The problem is there isn't that much global demand out there to pinch with weaker currencies, but imports are definitely falling in these emerging markets. Global trade is going negative because of that. And there's huge adjustments to come. Whether we can compare that with the big emerging market crises of 1997, 1998 is an interesting comparison. The Asia crisis, when countries had to go to the IMF cap in hand because they effectively ran out of money. I think the world's different now. I think they've built up shock absorbers. More free-floating exchange rates are much more common. Many have built up foreign exchange reserves.
I take the point about shock absorbers, Young. Very apologies for interrupting, but I just want to go to Tang on the point that you are making there. You have a country like South Africa, for example, that has an external debt that amounts to 40% of its gross domestic product. Now, that's a lot of liability, and a lot of that debt is in American dollars. Any change in the value of the dollar, sparked off perhaps by a rates increase, would have immense impact on South Africa and other emerging countries that we've heard mention of, Turkey, Brazil, for example, would it not?
Well, I'm going to weigh in there. I'm going to agree with the idea that the time of monetary tools is over. The Fed was forced to go all the way to zero because it had no choice. The impact of what they were doing became less and less, even though they were doing more and more. So coming out of it is going to be kind of like having a hangover. Unfortunately, the cure are structural structural changes, which you don't see many countries doing. The issue comes down to is stabilizing your government, making sure that it has enough, and getting your economies moving. Currently, there are really no major efforts other than the rebound idea that is pushing global markets, other than, I think, China's One Belt, One Road, which still has its issues as it goes forwards, especially its implementation. Dealing with 28 different countries, different governments, cultures, spanning a good part of the world is going to be a great difficulty. The question is, what other things are other countries doing it? You're not seeing much coming from Europe. You're not seeing much coming from the US in terms of how you get people back together. Reliance on the market is fine, but it's not enough by itself.
Well, Mike Norman, we heard there the issue of rates going down to zero. Now, one of the issues many argue too is that there needs to be a rate increase because with a rate set at around zero, there is no wiggle room. There's no way you can go should you need to offset any unforeseen developments within the market as a whole. Would you agree?
Well, not just that. I mean, you know, the Fed or central banks in general can continue on with asset purchases and expansion of balance sheets. You know, that has worked marginally. Some might argue, you know, it's been responsible for bubbles. But I'd like to throw in 2 points here. Number one, I would caution on making a prediction of a higher dollar just axiomatically when the Fed starts to raise interest rates. You know, the correlation there is a little bit tenuous. I mean, so we could actually see, and again, going back to this point that this rate hike cycle, when it does begin, has been highly anticipated. You know, it could be a buy the rumor, sell the news type of situation. The other point I want to make, which is very important, and it you know, ties in with your question, is that since the United States government is a net payer of interest, a hike in interest rate effectively is like a fiscal injection. It raises the interest income being paid to the non-government, to people out there, not just in the United States, but all over the world, of the 18.2 trillion of treasuries that are outstanding. So you could almost make the argument that where QE failed, where zero interest policy failed, was in the sense that it removed a tremendous amount of interest income, not just from the United States, but the global economy. It actually had a deflationary effect. So when we start to see that rate cycle go back the other way, it actually equates to a fiscal injection. You're going to see a rise in interest income as that component of personal income. You know, it might end up to be stimulative. Look, the last rate increase cycle that we saw in the United States, it lasted for about 3 years, from I believe 2003 to 2006. Rates went from 1% to 5.25%, the Fed funds rate. It took all that time until we started to see really the negative impact on the housing sector. So we're going to get incremental rate increases. It's not like they're going to go from 0% to 5%. They're going to do very incrementally. So, the economies, the anticipation of this, the outcome might not be as turbulent or negative as many people think it will be.
Well, Jan Randolph, a very important point there that I want to get your opinion on, the possibility or the thesis that high interest rates may not result in a shift in the value of the dollar. That would appear to be a very important point for the world as a whole, would it not?
Yeah, I think what we've seen in terms of the major exchange rates over the last few years, a shift basically based around at what stage each of the main central banks are with monetary accommodation. Obviously, the US Fed is ahead of, for example, the ECB and the Japanese Bank of Japan. That has tended to argue in favor of the strengthening US dollar. And with an interest rate income, no matter how small, does make US assets relatively more attractive. It's as simple as that. And that could attract global flows and thereby strengthen the dollar. So we could still see strengthening dollar ahead, as we've seen in recent months, in anticipation of these changing rates relative to Europe, relative to Japan. I think the more important risk for the Fed here is, again, timing. Is the US economy strong enough? For so long, the Bank of International Settlements in Basel have warned that keeping rates this low for so long creates the seeds of the next financial crisis. It smothers relative pricing. It's difficult to really understand where risk is, where you've got low interest rates everywhere and central banks coming in as huge banks themselves as purchasers of assets, everything from government bonds to mortgages. It makes it difficult to understand where the relative risks are. And we don't know that until rates rise. And those that have gorged on cheap credit may not be able to withstand this tightening cycle. And those may exist in the United States itself, but it may also exist in the emerging market world.
Well, if I may, Jan, I just want to go to Ina Tangen on another point that Mike Norman brought up there. The possibility that an interest rates rise could actually stimulate global economy, the fiscal injection that could occur through such a move by the federal bank. Do you believe that there's a validity to that particular argument?
I think we're not looking at it the right way. The perspective here should be there is nowhere to go except upwards. They must do this. The effect that has happened here is that they've had a massive injection, as has been pointed out, and there's so much money chasing yield that it's basically reduced it to nothing. And this has resulted in bubbles created everywhere. Unless those bubbles are started to ease, you're going to have massive impacts from them. I still think that there will be some quite significant ones in both property market and in continuing one in the equities. There's no reason why these are going up. In terms of how does that eventually stimulate the economy, I think once people start looking at real returns instead of speculative returns or where do I put my money, that will start the process going again, and people will get back into things that are productive as opposed to speculative.
Well, at that particular point, my thanks to our guests, Mike Norman, Ina Tangen, and Jan Randolph. And thank you for watching. If you have any comments about today's show, do get in touch by going to our program page at aljazeera.com or post your comments at facebook.com/AJ Inside Story. You can also tweet us at AJ Inside Story. From me, Mike Hanna, and the whole team here, goodbye for now.